U.S. truckers and trucking companies are warning that we're in the middle of a freight recession worse than the 2008 crisis. As retail sales drop and both manufacturing and import activity continue to slow down due to lower consumer demand in 2023. The road transportation industry is seeing orders being cut in half, leading to falling cargo volumes all across the country. The collapse was the word used by one industry CEO to define what just happened to freight rates, and that is putting several trucking companies at serious risk of bankruptcy. But according to Western States Trucking Association, the ongoing downturn in the freight market is only a sign something far more distressing is about to break out in America. That's what we're going to expose in today's video. But before moving on, we kindly ask you to support our work with a thumbs up, and don't forget to subscribe to our channel so you don't miss our upcoming videos. 2 years after stimulus checks fueled the boom in consumer demand that broke supply chains and clogged U.S. ports, freight demand is falling off a cliff, industry leaders report. Many trucking companies are saying this is the worst freight market since the Great Recession, and we've compiled evidence that supports their statements. Both independent truck drivers and larger carriers are now witnessing a 180-degree shift in demand compared to 2021 levels. When the health crisis locked people at home and Americans started to order more goods online, the freight market boomed, and rates shot up by up to 500% in some areas. But things started to cool off in 2022, and since then, per-mile rates have been plunging at the fastest pace on record. By November, prices were already nearing pre-pandemic levels. On the other hand, higher maintenance prices, as well as an increase in the cost of capital and other difficulties in operating, have resulted in a brutal mix for a notoriously cyclical industry, one that has the potential to be worse than famous trucking downturns experienced in 2019 and in 2008-2009. The freight market is one of the most volatile markets on the planet. Hot markets can turn ice cold in a flash, particularly after the federal government and central bankers flooded our economy with so much liquidity and then proceeded to institute the fastest monetary tightening cycle in history, wrote Craig Fuller, CEO at FreightWaves, in a March report. Back in the 1970s, long-haul trucking used to be a stable, high-paying job, but decades of deregulation and poor working arrangements made many truckers leave the industry. They typically had to work grueling hours for little pay in conditions that could put them and everyone else on the road in serious danger. When the health emergency broke out, the transportation sector was short on 100,000 truckers, and the record freight rates recorded back then attracted many newcomers to the industry. Today, instead of a shortage, the freight market is flooded with thousands of small-scale owner-operators and carriers of all sizes. There was a lot of talk of a truck driver shortage, noted FreightWaves analyst Rachel Premack, and people started to think, oh, there's a shortage in this industry. I should jump in. I should make a quick buck. I should really profit off of this. Too many folks get in, and pretty soon after that, what goes up must go down, she said. Premack estimates that some drivers may have pulled in as much as $400,000 in income during the boom. According to Bloomberg, in a span of 18 months, the number of trucks on the road exploded as drivers chased those high per-mile rates of 2021, while big companies started to expand their operations and take market share. But the threat of a deep recession is now reducing demand for goods, and as a result, cargo volumes are plunging all over the United States. In previous trucking downturns, not only did you see a slowdown in volume related to the industrial economy, but you also saw an overbuild of capacity, Fuller added. In other words, with the number of drivers increasing, the market has seen a massive surge in trucking capacity over the past year and a half. But given that demand for freight was going down at the same time as more trucking services started to become available for companies, today there is far more trucking capacity than cargo volume to be transported in the U.S. One major piece of evidence that a major shift is already in course is the fact that the tender rejection rate is shrinking, as evidenced by the national truckload. Just like airlines, individual drivers or individual carriers tend to overbook their loads and often have to reject shipper requests. The harder the market, the more they'll simply reject a job. A couple of years ago, nearly 30% of outbound tenders were being rejected, mostly because capacity was extremely tight. But fast forward to today, we're in the opposite environment, with tender rejections having fallen to below even the lows seen during the pandemic. On top of that, data provided by FreightWaves shows that the per-mile rate fell to $1.49. At the peak of the boom in 2021, drivers were pulling in as much as $3.01 per mile. This means that freight rates declined by 52% so far and could go even lower in the months ahead. In fact, Senator CEO Patrick Berglund said that collapse was the only appropriate descriptive word for what happened to freight and shipping rates in 2023. This is the largest drop we've ever experienced on Senator's Index of Rates, which charts real-time global rates developments, and it paints a bleak picture of the state of the industry, he said. Meanwhile, operating costs are going through the roof, and a shortage of mechanics who can work on diesel trucks is also adding pressure on truckers this year. This means there's far less money to be made in the sector. For those who made high investments to be able to enter the industry and to profit from the boom, this may be just the beginning of a financial disaster. Since December, thousands of small carriers have revoked their operating authority, and bankruptcies started to arise in the trucking industry. Up until February, only 7 bankruptcies were announced. In March, however, things took a drastic turn for the worse. FreightWaves started to receive alerts from sources about a number of overnight shutdowns or carrier wind-downs that only happen when conditions are suddenly bleak. The analysts say that the crisis they're witnessing right now is much more serious than the 2019 slowdown that became known as the trucking bloodbath. On March the 6th, FreightWorks Transportation, a North Carolina truckload carrier with 200 trucks, announced it was shutting down. An executive from the carrier revealed that a large, long-term shipper suddenly pulled freight from the company and gave it to another carrier. This set off a series of cascading events that forced it to wind down its operations. On March 22nd, FreightWaves reported that Flagship Transport, a Miami-based carrier with 455 trucks under contract, suddenly stopped paying its bills, abruptly shuttered, and stopped answering calls from drivers. On March 24th, another Miami-based trucking company, Solar and Solar Hauling, with 42 drivers, filed for bankruptcy. Often, carriers living on the edge are the most vulnerable in market climates like the one that our industry is facing, the experts highlighted. Joe Reikovach, the Director of Governmental Affairs and Communications for the Western States Trucking Association, revealed that over 15,000 small business truckers who got in at the peak of the market and found themselves saddled with expensive equipment have already gone out of business in his area so far this year. The president of J.B. Hunt, one of the largest trucking companies in the U.S., said this market is facing the poorest conditions in perhaps 15 years. To make things worse, a recent CNBC supply chain survey that analyzed inventories and warehouse space tracked a decrease in truck movements in and out of the warehouse, and he revealed that ocean freight orders are down 50% year over year, and that will keep impacting both rail and road transportation in the short and long run, with trucking executives calling it freight recession. This, along with a 40% decrease in manufacturing orders, are very bad news for the freight market. UPS CEO Carol Tomé cited a deceleration in U.S. retail sales as a factor in lower than anticipated volume and ongoing demand weakness. If volumes fall further, which is the most likely scenario for the rest of the year, the entire trucking industry is at risk of facing an unprecedented wave of bankruptcies. The conditions in the freight market are dependent upon the balance of supply and demand, but when demand is gone, everything starts to fall apart. Retailers are bearing the brunt of this crisis too. That's what led major companies like Target to lose 90% of their profits in one single quarter. In a short few months, consumers were no longer interested or no longer had the purchasing power to continue to spend on big-ticket items, and many retail businesses realized there was just too much inventory and started canceling billions in orders and also marking prices down. Truckers and carriers are now going down the same tortuous path. They're having bookings canceled and watching a hot market become stone cold. FreightWaves executives argue that the very policies designed to reduce inflation for consumers may be exacerbating stress on the supply side. They say that one of the things to remember, trucking is a capital-intensive industry. It actually has one of the lowest returns on capital of any industry in the world, but it requires a lot of capital. Many of the new trucking companies finance their working capital and they finance their trucks, but tighter conditions for borrowing and rising interest rates are contributing to their demise. For their part, U.S. consumers are facing financial stresses from a lot of different directions: higher mortgages, rising rents, auto loans, and the soaring cost of bare necessities are eating up people's budgets. And after paying all their bills, Americans aren't left with a lot of money to spend on other goods. For millions of people carrying student loan debt, inflation has become far too oppressive, and the recent lift of the moratoria on student loans means that about 47 million Americans aged 18 to 44 are going to face an estimated loss of $393 on discretionary spending this year. Fewer dollars to spend will continue to reduce consumption, not only this year, but in 2024 and beyond. As trucking demand plunges, so have diesel prices. Today, a gallon of diesel costs $3.77 on average, and that's down from an all-time high of $5.82 last June. And that's according to the American Automobile Association, the AAA. But experts with the Western States Trucking Association say that the freight recession is only a harbinger of something, frankly, much worse. The economic recession that's now upon us is going to shake entire industries to the core. Millions of layoffs are expected, and economic and financial uncertainty will only grow worse. The crisis that's now unfolding before us will be unlike anything we've ever experienced. And the freight market meltdown is just one of the multiple indicators that something is terribly wrong in our system, and that the dominoes have already started to fall. What do you think? We look forward to reading your comments under this video, and thank you for watching.